When money loses value, it is not just the economy that collapses. It is trust, stability, and even social peace. Powerful empires have fallen not because of external wars, but because of internal financial mistakes. And the question that echoes today is unsettling. Are we repeating the same steps? Throughout history, poorly managed financial systems have destroyed entire societies. It was not overnight. It was slow, silent, until it became impossible to ignore. Today, we live surrounded by rising debts, large-scale printing of money, and cyclical crises. This video is not about panic. It's about understanding, because when you understand the past, you can see signs in the present, and some of these signs are closer than we imagine. Before you continue, like it now and subscribe to the channel. This helps this content reach more people and strengthens our community. If you care about your financial future and want to understand the world beyond headlines, this is where you belong. When money lost its value in Rome, the Roman Empire was one of the greatest powers in history. For centuries, it expanded territories, built roads, strengthened trade, and consolidated military power. But maintaining such a vast empire was expensive. Armies needed to be paid for. Infrastructure required maintenance. And when the revenues were not enough, a seemingly simple solution emerged: reduce the real value of the currency. The Roman currency, denarius, was initially made with a high silver content. Over time, to finance increasing spending, the rulers began to decrease the amount of silver in coins by mixing cheaper metals. The coin continued to look the same, but its real value was lower. At first, few noticed, but traders soon realized they were getting less real value for the same product. Prices began to rise. Inflation gained strength. Purchasing power fell. Trust in the system weakened. When people stopped trusting the currency, they stopped trusting the system itself. Trade slows down. The market becomes unstable. Inequality is growing. And that was not just an economic problem, it has become a social problem. In the 3rd century, the Roman Empire faced severe inflation, political crises, and military instability. The devaluation of the currency was not the only cause of the fall, but it was a major factor that weakened the internal structure of the empire. The lesson here is not to simplify history. Empires are complex and fall for multiple reasons, but the currency manipulation had real and documented consequences. When money loses credibility, society feels the impact. Today, we don't use silver coins. We live in the age of digital money and modern monetary policies. But the basis remains the same: trust. Without trust, the system wobbles. Weimar Germany and the collapse of confidence. In the early 20th century, Germany experienced one of the most dramatic episodes in modern economic history. After World War I, the country was devastated. In addition to physical and human destruction, there was a heavy war debt imposed by the Treaty of Versailles. The government had to pay huge reparations while its economy was weakening. Lacking sufficient revenue and pressured by external obligations, the government began printing large amounts of money. The intention was clear: stimulate the economy and fulfill commitments. But the effect was devastating. In 1921, inflation began to rise. In 1922, it skyrocketed. In 1923, it completely went out of control. What we call hyperinflation has transformed people's daily lives into a surreal scenario. Salaries had to be paid daily, because the next day they no longer bought almost anything. Documented stories show people carrying money baskets to buy bread, and sometimes the value of the bread increased on the way to the bakery. It was not magic. It was not conspiracy theory. It was an imbalance between real production and monetary expansion in an already fragile environment. When there is too much money circulating and not enough production in proportion, prices rise. When prices rise too fast, confidence disappears. The consequence was not only economic. The middle class lost their savings. Workers saw decades of effort disappear. Financial instability fueled social frustration and political polarization. History shows that deep economic crises can make room for extremism and radical change. It is important to make one thing clear: the post-war context of Germany was unique, with specific factors such as severe foreign debts and territorial occupation. It is not correct to compare directly with any current country, but the economic principle remains valid. Trust is the basis of money. Money, at bottom, is a collective agreement. It works because everyone believes that it will have value tomorrow. When this belief breaks down, the system collapses. Today, we live in an interconnected global economy. Central banks use more sophisticated tools to control inflation and financial stability. There are mechanisms of regulation and monitoring that did not exist at that time. Even so, modern crises show that no system is entirely immune to error. The question that remains is not whether we are in hyperinflation, because each country experiences different realities. The question is, are we paying attention to signs of imbalance? Are we understanding how financial decisions affect our daily lives? When markets collapse, 1929 and the domino effect. In 1929, the world witnessed one of the biggest financial collapses in history, the collapse of the New York Stock Exchange. The event became known as the Great Depression, and its consequences went beyond borders, affecting economies on every continent. In the years before the collapse, there was a climate of extreme optimism. Companies grew rapidly, investors bought stocks with borrowed money, and many believed that prices would continue to rise indefinitely. This phenomenon is known as a speculative bubble, when prices rise not just on economic grounds, but through collective euphoria. But bubbles don't last forever. When confidence began to falter, investors rushed to sell their shares. Panic spread. Millions lost their savings. Banks that had lent money for risky investments began to fail. Without sound banks, firms could not borrow. Without credit, businesses closed. Without businesses, workers lost jobs. The financial system is like an interconnected network. When a major part fails, the impact spreads. That's what happened. The financial crisis turned into an economic crisis, and then a social crisis. Unemployment soared. Industrial production fell sharply. Entire families faced extreme poverty. International trade has shrunk, further deepening the global recession. It is crucial to understand, it was not just the fall of the stock market that caused all this. There were structural fragilities, excessive speculation, lack of adequate regulation, and an exaggerated confidence in infinite growth. After the crisis, many reforms were implemented. In the United States, for example, new rules have emerged to oversee banks and financial markets. Governments have learned, at least in part, that financial systems need to balance freedom and responsibility. What does this history teach us? First, when growth seems too easy, there can be hidden risks. Second, financial systems rely heavily on collective trust. Third, when that trust breaks down, the effects go far beyond numbers to real lives. Today, markets are more regulated and transparent than in 1929, but we still face cycles of euphoria and fear. Financial crises continue to occur, albeit in different contexts. The difference is in information. Today you have access to knowledge, can understand what's going on, question decisions, and better protect your resources. Modern crises, when the system almost stopped. If you think big financial collapses are in the distant past, think again. In 2008, the world faced one of the greatest crises since the Great Depression, the 2008 financial crisis. It all started in the U.S. real estate market. For years, banks have provided real estate loans to people with low ability to pay. These loans, known as subprime, were pooled and sold as complex financial products to investors worldwide. It seemed profitable, it seemed safe, but there was an invisible problem. Many of these loans had a high risk of default. When the borrowers began to default, the entire structure began to tremble. Huge financial institutions faced billions of dollars in losses. In September 2008, investment bank Lehman Brothers filed for bankruptcy. The shock was immediate. Banks began to mistrust each other. Credit was practically frozen. Companies could not finance. Unemployment rose. Global markets have plummeted. Again, the problem was not just technical. It was psychological. When trust disappears, the system crashes. And financial systems are driven by trust. Governments and central banks intervened with emergency measures. Trillions of dollars were injected into the economy to stabilize markets and prevent an even bigger collapse. New regulations were implemented to reduce systemic risks. But this crisis has left deep scars, showing how interconnected global financial systems are. A fault in one sector can spread rapidly around the world. It is important to note, the global economy has not collapsed completely. Institutions have learned, adjusted rules, and strengthened oversight mechanisms, but the crisis has revealed real vulnerabilities. Today, we live in an era of high public debt, digital markets, cryptocurrencies, and instant transactions. The system is faster, more complex, and more integrated than ever. This does not mean that a collapse is inevitable, but it means that balance, transparency, and accountability are essential. History shows a pattern. Excessive risk, blind trust, and lack of control can lead to serious consequences. It is not alarmism, it's historical analysis. And when we understand these patterns, we are less vulnerable to collective panic and more prepared to make conscious decisions. What is really at stake now? After looking at Rome, 20th century Germany, 1929, and 2008, one thing is clear. Financial systems do not break down just because of the wrong numbers. They break down when trust, responsibility, and balance stop walking together. Today, the world lives a different reality, but it is not immune to risk. Many countries operate with high levels of public debt. Central banks use complex monetary policies to control inflation and stimulate growth. Markets react in seconds to any news, and millions of people directly depend on financial stability for survival. But here is the most important point. Crises do not arise out of thin air. They are built over time, with accumulated decisions, misaligned incentives, and overconfidence in infinite growth. This does not mean that we are doomed to repeat the past. The big difference of our time is access to information. You can learn about basic economics, can understand concepts such as inflation, debt, interest, and diversification, can avoid impulsive decisions driven only by fear or euphoria. History shows that the most resilient societies are those where people understand the system in which they live. When people understand how money works, they take more responsibility, make more informed decisions, and reduce the chance of collective panic. Another key point: financial systems are tools. They may be misused, but they can also be corrected, adjusted, and strengthened. After each major crisis, new rules have emerged. New structures were created. Learning, though painful, existed. The biggest risk is not the existence of a complex financial system. The biggest risk is ignorance about how it works. If you understand that money depends on trust, you realize that stability requires responsibility. If it is understood that bubbles arise from excessive euphoria, he learns to distrust promises of easy gains. If you understand that debt needs to be managed carefully, start looking beyond the headlines. Can the same happen now? The honest answer is, any human system can fail, but it can also evolve. History is not about generating fear. It's about generating consciousness. And consciousness breeds power. If this video has opened your eyes in any way, don't leave without acting. Like it now so that more people have access to this knowledge. Subscribe to the channel to continue understanding the world beyond headlines. And write in the comments, do you think we are more prepared than in the past? Or are we repeating patterns? Your participation strengthens this community.